$4.3 billion.
It is a massive number.
Yeah, I want you to just sit with that number for a moment. 4.3 billion, it's a staggering figure.
Yeah.
It's not a rounding error on a corporate balance sheet, and it's not a bad quarterly earnings report for a tech giant like Apple or Nvidia.
Right.
That is the specific dollar amount that retail investors, so, regular everyday people, mostly have lost in just two specific cryptocurrencies.
And I think it's important to clarify right off the bat, we aren't talking about random scam coins launched by anonymous developers in a basement somewhere.
No, not at all.
We are talking about the tokens directly linked to the Trump family.
Exactly. So for context, it's February 22, 2026. We are looking back at a story that has been developing for exactly a year now. We're doing a deep dive into the official Trump token and the Melania meme token.
Yeah.
And honestly, the new data that just dropped this week, it completely changes how we have to look at this whole event.
It really does. Because up until now, we had estimates, we had angry forum posts and a lot of speculation. But the blockchain doesn't lie. We now have a full, verifiable financial autopsy of what one research group is literally calling the biggest retail loss event for the political meme coin sector to date.
Which is a really heavy title, considering the wild history of crypto.
Very true.
But before we get deep into the weeds on this, let's just set the ground rules for today's deep dive.
Right.
This is not a political debate.
Right.
We aren't here to talk about voting patterns or whether you support the administration's policies or any of that.
Exactly. We are here to follow the money. Because when $4.3 billion just evaporates from retail wallets, it doesn't actually disappear. It goes somewhere.
Right. Energy is conserved.
Exactly. Energy is conserved, and in finance, wealth is transferred. Our mission today is to unpack the actual mechanics of that transfer based on the blockchain data.
So let's rewind the clock a bit to set the scene. Take yourself back to January 2025. The presidential inauguration is happening. The political world is absolutely buzzing.
Oh yeah, nonstop coverage.
And suddenly, right in the middle of all that pomp and circumstance, we get a highly publicized crypto launch. Walk us through that timeline, because it felt incredibly well compressed.
Compressed is definitely the right word. I mean, it was a blitz.
Yeah.
The official Trump token launched on January 17, 2025. Then, literally the very next day, January 18, the Melania token drops.
It's back to back.
Right back to back. This was clearly a coordinated dual launch strategy designed to capitalize on the maximum possible media attention surrounding the inauguration.
And the market reaction was just instantaneous. I remember looking at the charts during those first few days. It wasn't a slow discovery phase where people were figuring out what it was. It was immediate vertical price action.
Pure verticality. It was classic meme coin mania, but amplified by global household name recognition. The official Trump token started trading at roughly $1.20. And within just 48 hours, literally 2 days, it had surged to an all-time high of over $74.
$74. From $1.20, that is a massive multiple.
Insane returns.
If you were one of the lucky few who got in early and somehow timed the exact top, you were looking at life-changing money.
Absolutely. And the Melania token had a very similar trajectory. It hit $13.73 in that same short window. The hype cycle was faster than almost anything we'd seen in the previous cycle, faster even compared to the Dogecoin runs of the early 2020s.
But this is where I think we have to look at the underlying technicals, because a price tag of $74 sounds great on paper, but price is always a function of liquidity and supply.
Right.
When I look at the volume data from those first 48 hours, the order books look, thin.
That's the key observation. It was a classic low-float, high FDV situation.
And FDV being fully diluted valuation.
Correct. Because the insiders held so much of the total supply, which is a massive point we will get to in a minute, the actual number of tokens available for the public to trade on the open market was relatively small.
Which makes the price much easier to manipulate or just accidentally pump, right?
Exactly.
If there are only a few shares or tokens available, a sudden wave of retail buying pressure sends the price straight to the moon because there simply are no sellers at those lower levels.
Precisely. It creates a squeeze upwards. But as any seasoned trader will tell you, that knife cuts both ways. Once the momentum shifts and that retail liquidity dries up, the elevator down is much faster than the stairs up.
And that brings us to the new data. The report from CryptoRank that was published just a couple of days ago on February 20, 2026. The crash wasn't a slow bleed, it was a sheer cliff.
A total cliff. As of this week, the official Trump token is down 92% from that $74 peak.
92%. I mean, for most retail investors, that is statistically indistinguishable from zero.
It is. And the Millennia meme token is effectively dead. It's down 99% from its peak.
So if you put in $1,000 at the top because you got caught up in the inauguration hype, you have maybe $10 left.
If that.
Probably not even enough to pay the network gas fee to sell it.
Exactly. You are essentially locked into a total loss. You are stuck holding the bag. And this is where that $4.3 billion figure comes into play. That is the collective wealth destroyed across these two assets.
Well, it's just massive.
And the participation scale was unprecedented for a political token.
Yeah.
We are talking about nearly 2 million unique wallet addresses interacting with these contracts.
2 million wallets. Now, we know in the crypto space, one person can easily have multiple wallets. But even if you cut that number entirely in half, that is 1 million people, 1 million individuals, potentially voters, who bought into this financial narrative.
And the speed of the destruction is what really stands out in the forensic report. You mentioned the initial surge took about 48 hours.
Yeah.
Well, the bulk of the retail losses happened within just 19 days of the launch.
19 days, less than 3 weeks to wipe out billions.
There was a Chainalysis report commissioned by the New York Times that looked at the blockchain data right at that 19-day mark. At that point, over 800,000 wallets had already realized or were currently holding a combined loss of $2 billion.
That is staggering velocity for a crash. Usually, even in a brutal bear market, you have months of decline where people can talk themselves into holding, or maybe they get out with a 20% loss. This is just a flash crash that never recovered.
It really was. By May 2025, CNBC reported that out of those 2 million wallets, 764,000 were deeply in the red. They were totally underwater with no oxygen tank in sight.
Okay, let's pivot to the actual mechanics of the wealth transfer. Because like you said, markets are a zero-sum game in the short term.
Yes.
If retail investors lost $4.3 billion, that value didn't just vanish into thin air, it went into someone's pocket. Who was on the other side of this massive trade?
This is where the whole insiders versus retail narrative gets really, really stark. The CryptoRank data shows a massive structural imbalance. While retail was getting absolutely crushed, insiders netted over $600 million.
$600 million. And how exactly did they extract that? Was it just from dumping tokens on the open market?
It was a combination of direct token sales and, crucially, transaction fees. See, when you launch a token on a decentralized exchange, you provide the initial liquidity pool.
You essentially act as the exchange yourself.
Right. You are the house.
Yeah.
And the house always wins. You earn a percentage fee on every single trade, whether people are aggressively buying on the way up or panic selling on the way down.
Right, so even as people were fleeing the burning building,
Yeah.
the insiders were charging them an exit fee at the door?
That's a perfect analogy. And the efficiency of this extraction is frankly terrifying. There's a specific statistic from the data that floors me every time I look at it.
What is it?
For every single dollar that insiders pocketed, retail participants lost approximately $20.
A 20-to-1 loss-to-profit ratio. That doesn't look like a fair market. That looks like a funnel. A mechanism designed solely to move capital from the many directly to the few.
The wallet concentration data absolutely backs that up. We mentioned the 2 million participating wallets earlier.
Right.
Well, out of all that, only 58 wallets earn more than $10 million in profits each.
58 entities, walking away with the GDP of a small island nation.
Those 58 wallets accounted for $1.1 billion in total profit. Then you have another tier of 45 whale wallets that amassed $1.2 billion.
Unbelievable.
So you essentially have roughly 100 highly sophisticated participants capturing almost all of the upside, while hundreds of thousands of small retail wallets took the catastrophic hit.
It's the Pareto principle on steroids. But this brings us to the structure of the token itself. I think a lot of people, even those who know a little bit about crypto, assume that once a token is launched, it's out there in the wild. It's fully decentralized.
Right, that's the marketing pitch.
But when I look at the supply distribution here, decentralized is the absolute last word that comes to mind.
Oh, it is highly centralized. And that centralization is the structural reason behind the crash and the reason for the token's total inability to recover. You have to look at who actually holds the keys.
Which in this case is CIC Digital and Fight LLC?
Correct. These are the Trump-affiliated corporate entities. Together, they control 80% of the total token supply.
80%. So the public float, the actual tokens available for those 2 million people to buy and sell, was only 20% of the pie.
Exactly. And this creates a terrifying dynamic for anyone holding the token, which in finance is called a supply overhang.
Explain that for us.
Sure. So the total maximum supply is 1 billion tokens.
Mm.
These specific companies hold 800 million of them. And they aren't just holding them as a digital souvenir.
They are locked up, but not forever.
Right. There is currently an estimated $2.7 billion worth of these tokens sitting in those internal wallets. But they are on a phased release schedule that runs all the way through mid-2028.
Let's unpack that phased release schedule for a second. In traditional finance, we'd call this a vesting schedule.
Yes.
But usually, vesting happens when a startup company is actually growing and building value over time. Here, they are vesting tokens into a chart that is already down 92%.
It's like a massive dam that is pre-programmed to open its floodgates at regular intervals. The market knows this is happening. Sophisticated traders know that every month or every quarter, millions of brand new tokens are going to unlock and flood the market.
Which creates a permanent sell wall.
Exactly. Anytime the price tries to recover, say, a grassroots community of supporters tries to pump it back up, that new demand is immediately met with fresh supply from the issuers. The market is trying to swim upstream against a current of $2.7 billion in potential sell pressure.
It's a structural ceiling. You simply cannot sustain a price rally when 80% of the supply is just waiting to be dumped on your head.
And that is exactly why the price chart looks the way it does today. It's not just bad market sentiment, it's cold, hard math.
This naturally moves us into the broader consequences of this whole saga, because you can't have a $4.3 billion retail loss involving the family of the President of the United States without it spilling over into the halls of Congress.
No, you really can't.
This isn't just a niche financial story on crypto Twitter anymore. It's become a full-blown legislative crisis.
The fallout has been immense, and honestly, it's actively reshuffling the deck for the entire cryptocurrency industry. The criticism in Washington is strongly bipartisan, which is extremely rare these days.
Very true.
You have Democrats and Republicans both looking at this specific data and saying, this is a massive problem.
Let's talk about the specific bills that are now on the table because of this. I saw Representative Liccardo was leading the charge on one of them.
Yes. Representative Sam Liccardo introduced the Meme Act.
I do always appreciate Washington's commitment to a catchy acronym.
They definitely love their acronyms. It stands for something incredibly complicated, but the goal of the bill is very simple. It explicitly prohibits federal officials and their immediate families from issuing or endorsing digital assets.
Just a blanket ban.
Right. It's a direct, targeted response to this specific token launch. The logic behind the bill is that if you hold the levers of regulatory power, like influencing the SEC or the CFTC, you cannot simultaneously be launching speculative financial products to the public.
It's the ultimate conflict of interest. You can't be the referee and the quarterback at the exact same time.
Exactly. Then you have Representative Maxine Waters, who proposed the Stop Trump in Crypto Act. And beyond the House, the Senate actually passed a formal resolution condemning the president's financial ties to these specific tokens.
But here is where it gets incredibly frustrating for the broader crypto industry. I've been following the Genius and Clarity bills for a while now. These are supposed to be the boring bills, right? The ones that were finally supposed to actually fix the underlying plumbing of the industry.
Right. These were the legislative frameworks that everyone from developers to massive Wall Street firms actually wanted passed.
Right.
The Genius bill deals with stablecoins. It ensures the dollar reserves are actually sitting in a real bank so we don't have another catastrophic Terra Luna collapse.
Which we desperately need.
Exactly. And the Clarity bill was all about basic market structure, finally defining once and for all what constitutes a security and what constitutes a commodity in the digital asset space.
This is the exact stuff that institutional investors have been waiting for so they can enter the market safely and compliantly.
It's the safety belt the industry has been begging regulators for over the last 5 years. But now, those bills are completely stalled, just dead in the water.
Because of the Trump and Melania tokens.
Direct causality.
Yeah.
Key lawmakers, primarily Democrats, are citing this specific $4.3 billion retail loss as the explicit reason to oppose any crypto legislation that looks even slightly friendly to the industry. The argument being made in committee rooms is, look at the absolute chaos this family's unregulated project just caused. We cannot possibly move forward with a broader regulatory framework until we address this specific type of high-level abuse.
So just to be clear, the entire industry, we're talking stablecoins, decentralized finance, legitimate infrastructure projects, is being held hostage because of a meme coin rug pull.
That is the big so what of this entire deep dive.
Yeah.
The actions of a single family's speculative side project have effectively frozen the regulatory progress for $1 trillion global industry. It's like shutting down all national highway construction because one specific person crashed their car.
That is, well, it's wildly inefficient, but it's a very Washington outcome.
It's a perfect storm. You have widespread retail financial devastation, you have massive insider profit extraction, and now you have complete legislative gridlock.
Let's try to synthesize all of this for a second, because we've covered a lot of ground here. We have a $4.3 billion hole in the collective pockets of regular retail investors.
Correct. That money is gone.
We have a wealth transfer mechanism where insiders extracted value at a 20-to-1 ratio compared to the retail losses.
A highly efficient wealth extraction engine, really.
We have a tokenomic structure where the issuing corporate entities still hold 80% of the total supply, and they are legally allowed to keep selling it onto the open market through mid-2028, effectively capping any mathematical hope of a price recovery.
Right. The overhang ensures the selling pressure remains constant for years.
And finally, we have the collateral damage, where the necessary common sense regulations for the broader crypto space are now completely frozen in a partisan political standoff.
That really sums it up perfectly. It's a cautionary tale on almost every conceivable level. It exposes the extreme volatility of meme coins, the hidden dangers of centralized token supply, and the massive systemic risk that appears when high-level politics merges with unregulated decentralized finance.
You know, it brings up a really fundamental question for me about the very nature of these political assets. When a politician or their family launches a token, what are we actually looking at?
It's a great question.
Is it a financial product? Is it a piece of digital merchandise? Or is it really just a campaign donation with a few extra technological steps?
That is the billion-dollar question right there. If you look purely at the on-chain capital flows, it functioned exactly like a donation. The money moved from the political base directly to the leaders' affiliated entities.
Right.
But it was marketed and sold as an investment. It was sold on social media as a ticket to the moon. And that massive mismatch between retail expectation and structural reality is exactly where the $4.3 billion loss comes from.
And with that massive insider supply still unlocking for another 2 full years, the story isn't over yet.
Not at all. Every single month, more tokens hit the ledger. For the retail holders who are still stubbornly hoping for a magical rebound, they are quite literally fighting against the math of the smart contract itself.
It's a sobering reality check. But look, that is exactly why we do this. To look past the hype, look past the political noise, and read the code. Or at least talk to the experts who read the code.
Always check the tokenomics before you buy anything. Always look at the wallet distribution, because if the founding team holds 80% of the supply, you aren't the customer. You're the exit liquidity.
Oof. You are the exit liquidity. That phrase is definitely going to stick with me.
It's harsh, but it's the unavoidable truth of this specific case.
Well, we are going to have to leave it there for today. A massive financial loss, a stalled Congress, and a very expensive lesson in market structure.
Indeed it is.
I want to leave you with a final thought to chew on today. With the Meme Act currently sitting on the table in Washington, we might be looking at the last time a sitting president ever attempts something like this. But ask yourself this. If the token hadn't crashed, if it had somehow stayed at $74 and everyone got rich, would we currently be calling it a massive conflict of interest? Or would we be calling it a financial revolution?
That is a very uncomfortable question to ask.
It is. But that's what we do here. Thanks for joining us on this deep dive. Stay curious, always check your sources, and keep an eye on those wallet transfers. We'll see you next time.
Thanks for having me.